raise your hand if you can see my whiteboard that says financial planning topic, year-end planning. Great. Now, if you're a client, you've received our form, our year-end planning form. If you haven't filled it out and returned it, please do that. But let's talk about what you should be focusing on. Now, this is very, very simple, but very important to review. The first is capital gains and losses. See this? Okay. Capital gains and losses. So these are for our taxable accounts. You cannot take losses in IRAs. So if you remember our buckets, right? We have taxable, tax deferred, and tax-free. So we're just focusing on this area here. So these are your stocks. See, this is one of the problems. There's such a delay here in this whiteboard. But we have stocks, we have mutual funds, we have CDs, we have cash accounts, we have all this. So, and you know this is taxable because every year you get a 1099, and you get 1099s for short-term gains, long-term gains, dividends, and interest. So this is a year that we can use this to our favor, the downside of the market, right? Because we can do what's called tax loss harvesting. And we talked about that a few weeks ago in our investment fundamental series. But many of you have sold positions. Either you needed the money for something, or you just strategically, or we, for you, strategically sold out of positions and you have some losses. So now you also may have some gains, because there are many people who are taking distributions. They have built-in gains over the years, and they may have gains for the years. So you should be looking at, okay, what are my capital gains and capital losses year to date? So you can do some planning on that, because if you have capital losses, it might help save you tax. If you have capital gains, if they're short-term gains, they're going to add right into the marginal tax rate, just like you earn that money. And if it's long-term gains, then it's potentially taxed more efficiently, can be 0 all the way up to 20%, and there could be a 3.8% surcharge tax on that if you make over certain amounts of money. So this is vital, and you don't want to be surprised by this. So it's almost November. You should have a good idea of what these capital gains and losses are going to be, except for mutual funds. So one of the problems with mutual funds is mutual funds trade all year long, and they have internal gains and losses that then they have to pass out to their investors at the end of the year. It's very, very, very common and possible that even if you have a mutual fund that's down for the year, let's just say you have a mutual fund that follows the S&P 500, and you end up being down 20% for the year, you could still have capital gains in that coming out of that fund. And that is a very frustrating situation. So you should be getting notification from your mutual funds sometime very soon about what those embedded gains are. So pay attention to capital gains and losses, not only investments, but also real estate. Some of you have bought and sold real estate throughout the year. Don't forget about that, right? There are potential gains in those real estate investments. For many of you, there certainly are. Some of you may have sold a business throughout the year, and of course, there may be capital gains in that. So you got to factor capital gains and losses in, kind of do a, even just a projected calculation for the end of the year. So because there's still time to do things. Maybe if you realize that, hey, here's an example. Let's just say you've got $10,000 worth of gains in your investments. And then you look at your investment accounts and say, well, wait a minute. I've got $10,000 worth of gains from things that I took out during the year, but if I sell this one fund or this one position right now, I've got a $10,000 loss in that. Now you could sell it today, and if you really like it, you could buy it again in 31 days. And what you've done is you've booked that loss, and that $10,000 loss offsets that $10,000 gain. So then you have zero tax, right, on that It's not 0%, it's $0 tax on that. So you still have time, but if suddenly you realize this in January, it's too late. So that's why year-end planning is so important. And I know this is one of the problems, this changes in the whiteboard. It's not as responsive. So if anybody knows Bill Gates, let him know I'm not happy. Retirement plan distributions. So either retirement plan or IRA distributions. Some people forget, believe it or not, that they've taken distributions from their retirement plans or their IRAs. You know, I once had a woman, a longtime client, and she called me one time. This goes back several years ago, but she called me one time. She said, Mark, I can't believe it. The account's down $45,000 since the last statement. And that's just unacceptable. It seems like a lot of money. And I had to remind her that she took a $45,000 distribution to buy a car. And she said, oh my gosh, I'm so embarrassed. But that happens. People forget, or you don't realize how much you've taken. Okay, so here we are in October, almost November. Could it be that maybe you did a potentially a large distribution early in the year for something that you had planned or unplanned, and it's completely escaped your mind, or maybe in your brain you thought that it was the year before? So review those distributions from your retirement plans and your IRAs or your taxable accounts, even your taxable accounts, because again, you could have capital gains and losses. Now, unfortunately, I showed you up here how capital losses offset capital gains, and there's some rules around short-term losses and how they offset against short-term losses and then long-term. You know, so that's something you can work out with your CPA. If you need help, I can help you. Unfortunately, capital gains don't offset distributions, right? So you can if you have more losses then you can take it in any 1 year. You can offset it by $3,000 a year. You can write that off against your income, but it's not going to be that meaningful for most people, but it helps. But if you have, say, $30,000 in IRA distributions and you have $30,000 in capital losses, it doesn't mean anything, right? If you can't offset your losses against your gains, you can carry $3,000 forward until they're used up, but don't think that capital gains or capital losses are going to offset distributions or income other than the 3,000. Income projections. You may have worked this year. You may have a bonus due. It's good to do some calculations on what that income is going to be, because you know there again may be some things that you could do. If you're still working, maybe you can make a Roth contribution. Again, you could do that after the first of the year, but there are you might be able to purchase some equipment or something like that. I don't know, but it's good to look at income projections. Tax payments. So many of our clients are, so we talked about that. Many of our clients are making estimated payments throughout the year. It's good to calculate those and see what you've paid throughout the year and see if you need to catch up. Maybe you paid a little too much. Don't know. But go through your tax payments. Deductible expenses. Did you do any charitable contributions that maybe you weren't planning for, or maybe you were planning for? Let's make sure we're calculating those and keeping those up to date and projecting what they're going to be for the rest of the year or total year 2022. So deductible expenses is another one. And of course, Roth conversions. Roth conversions planned and already completed. Believe it or not, people forget we've been doing Roth conversions throughout the year for many people, whether they were planned or whether they, hey, let's take advantage of the markets being down. It's something we can execute quickly. Take a look at everything. Let's say your plan was to do $300,000 for the year and you've completed $250,000. Let's make sure, first of all, we get that extra $50,000 done by the end of the year. Because once the year passes, as you heard Sarah remind us, that's it. Can't go any further than December 31. And for most people, it's well before that. Our soft deadline is December 1st to have all Roth conversions completed. Our hard deadline is December 15th. So there could be other things too. So we'll just go ... and others and so on. But it's important to look at things for your year-end planning. All right. I don't see any questions. All right. We talked about some slot updates. We talked about the market updates. We talked a little bit about Social Security, and we reviewed your year-end planning for our financial planning topic. That's it for today. It's 10:47. I hope you have a great rest of your day. I hope you have a great rest of your week. I'm scheduled to see you soon. I look forward to seeing you. I'll talk to you soon. Take care. See you tomorrow night. Bye-bye.